Welcome to the Basic Financial Analysis, Ratios, and Performance Monitoring in Microfinance Banks, Part 2, Lecture 3 course. In this lecture, we will be talking about assessing your clients. The only way we can adequately assess clients is by going through their books of account. Note that even the most uneducated of your customers has a book of accounts they don't know about. A client's financial statement is quite easy to source and understand. All you need is a pen and paper, and your balance sheet, profit and loss, and your cash flow statement will be ready in no time. Remember, we are dealing with the client's financials only, no need for bulky assessment sheets. Just ask a few questions, and your books are ready. In this chapter, we will be looking at the balance sheet components only. We will be studying liability and equity in the next lectures. These three documents cannot work in isolation, so we'll need to study them in the next lectures. Now let's start with the balance sheet. What is a balance sheet? This shows the state of affairs of a client's business at a particular time. The snapshot at the time of assessment is what confirms the static nature of the analysis taken. What does a balance sheet do? It shows us where assets and liabilities are placed in the table. It shows us the source of the assets and liabilities. It shows us the worth of the business. It shows the liquidity position of the business. Basic information needed for the balance sheet: cash, bank balances, debts from customers, prepayments to suppliers, stock/inventory, fixed assets, debts to suppliers, prepayments from customers, loans from other sources, formal and informal sectors. Once you have knowledge of all the above from your customer, you sure have a complete balance sheet you can work with to have a snapshot of your customer's business. Analyzing statement of financial position, balance sheet. Before analyzing the balance sheet, you need to understand how assets and liabilities work. Every asset focuses on the use of fund, while liability focuses on the source of fund. Let me break it down, but before this, I know you might be wondering why all this accounting scenario in microfinance application. The correlation is very important to understand the metric used to judge the performance of microfinance operations both from the customer's perspective and the business perspective. Assets, use of fund, comprises of money invested to acquire resources, can be on a short or long-term basis, must balance with liability. Liability, source of fund, funds provided by creditors for the business, can be on a short or long-term basis, must balance with asset. Now we analyze the statement of financial position, balance sheet. The balance sheet comprises of three important components, namely, asset, liability and equity. Let's discuss assets. These are tangible and intangible resources that the business own. They represent use of fund and investment for future generation of revenue for the business. Items in the business asset usually include but are not limited to cash, short or long-term investments, prepaid expenses, account receivables, fixed assets, vehicles, equipments and landed property. Liabilities, these are what the business owes to other parties or what has been incurred which must be paid in due course or in the near future. They represent source of fund for investment and must be accounted for. Liabilities are very important sources of funds for any growing business operations. It is a very efficient and effective way of generating revenue which can be assessed through borrowing from other financial institutions, funds raised through savings and fixed/term deposits or through donor activities from family members. Client liability items usually include but are not limited to partnership contribution, funds borrowed from other sources, account payables, other acceptable source of finance, equity. Equity is also recognized as net worth or capital. It shows what the business owns and is made up of accumulated surplus/deficit from the client's business transaction. Activities in the equity determine the payment of dividends to shareholders of the business. Balance sheet items. Cash. Item under cash includes cash at hand as at time of assessment, cash in bank savings, current or other forms of legal account confirmed from the account statement by the business, accounts receivables. These are financial expectations from customers, whom the business has delivered goods on credit and is expecting payment, for goods or asset that have been paid for but has not yet been received. Stock/inventory, includes, finished goods and ready for sale at cost value, semi-finished products, raw material that is easily convertible finished products and not inclusive of old stock that has no value to the business, inclusive of client's own goods and not the ones he purchased on credit. Fixed assets, This is made up of vehicles used for the business, plant and machinery, small and heavy equipments, land/premises owned, accounts payable. Include bills owed to supplier for material delivered to the client but has not yet been paid, advance payment made by customer and received by the client but the goods have not been delivered to the client's customer, running overdue expenses not yet paid, i.e. staff salaries, tax etc., short-term debt. These comprises of short-term debts or loans from different sources due not more than 12 months, payables due but not paid within 12 months, long-term debt. These comprises of long-term debts or loan from different sources due but more than 12 months, funds sourced for financing long-term investment, could be formal or informal debt. Owner's equity, the owner's contribution to the business, determined once balance of liability is deducted from total asset. Types of balance sheet. The balance sheet can be constructed in two ways, position or types. They are either A. Horizontal, B. Vertical. Note, while they take different forms, the result is the same. Remember, basic accounting equation follows that asset equals liabilities equity, or equity equals assets, liabilities or liabilities equals asset, equity. Balance sheet workings. Let's take this sample question to give us a better understanding of the workings of a client's balance sheet. Questions. A prospective client wants to assess a $500,000 loan from your microfinance bank. In your assessment analysis of his business, you discovered that the client is currently owing another institution the sum of $40,000. The client has an inventory of $750,000 and is expecting receivables of $350,000. He currently has the sum of $35,000 with him, which includes his sales for the day, with a total of $74,500 in his bank account. His total business assets are worth $1,020,000. Construct a balance sheet for the customer. There you have it. All you just have to do is ask your customers these basic questions and your client balance sheet is ready for use. Note, the statement of financial position and the balance sheet are used interchangeable. Also, the focus of this lecture is for microfinance professionals and credit officers in particular to understand how to properly access a potential loan customer balance sheet. This concludes our lesion for Lecture 3. See you Lecture 4.